Most people believe markets react to news. A headline breaks, prices move. Bad news pushes markets down. Good news lifts them up. That explanation feels intuitive, and it's comforting because it suggests markets are responding to the same information everyone can see at the same time. But that belief is incomplete. Markets don't fear bad news. They fear what most people haven't noticed yet. By the time a headline reaches your screen, it has already been read, debated, hedged, and positioned around by participants who operate far ahead of public attention. What moves prices is rarely the news itself, but the change in underlying conditions that the headline fails to explain. This is why markets can fall on good news and rise on bad news. It's also why periods that feel calm on the surface often precede meaningful shifts beneath it. Liquidity, positioning, funding conditions, and risk tolerance change quietly, long before sentiment follows. For long-term investors, especially those thinking about retirement, this distinction matters because reacting to headlines often leads to emotional decisions, while understanding structure encourages patience and discipline. Today's conversation is not about predicting the next move or reacting to short-term volatility. It's about stepping back and asking a better question. What has actually changed beneath the surface? And why does that matter over years, not days? Once we answer that, the price movements start to make a lot more sense. Over the past several weeks, financial markets experienced a noticeable increase in volatility across multiple asset classes. Gold and silver prices moved sharply higher during the first part of the period, followed by a rapid pullback over a very short time window. The move up occurred over days. The correction that followed was compressed into a much shorter time frame, with a large portion of the decline happening in a single trading session. This created the perception of instability, even though prices remained well above levels seen earlier in the year. At the same time, U.S. equity markets, including broad market indices, continued to trade near historically elevated levels. While daily fluctuations increased, there was no broad-based equity market breakdown. Trading volumes during the metals pullback spiked relative to recent averages, indicating that the adjustment happened quickly rather than gradually. From a timing perspective, the metals rally followed a period of extended consolidation, during which prices moved sideways within a relatively narrow range. The subsequent breakout attracted additional short-term participation, which contributed to the speed of the advance. When prices reversed, that same positioning amplified the pullback. Compared to the prior month, the key difference was speed, not direction. Prices changed faster, but they did not return to prior long-term support levels. On a multi-year chart, both gold and silver remained in higher ranges than those that defined most of the previous decade. Importantly, there were no confirmed changes to long-term monetary policy frameworks, retirement systems, or official reserve structures during this period. Economic data releases continued on their normal schedule, and no emergency policy actions were announced. In other words, what changed was price behavior, not the underlying rules of the system. Volatility increased, positioning adjusted, short-term expectations were reset. This section establishes the factual backdrop. Prices moved quickly, sentiment shifted abruptly, but the broader financial environment remained structurally consistent with what existed weeks earlier. Short-term price movements matter less on their own than why they occur. To understand the implications, it's important to separate headlines from mechanics and examine the chain reactions beneath the surface. The first-order effect of rapid price increases in gold and silver is straightforward. Rising prices attract attention. As prices move above recent ranges, participation broadens beyond long-term holders to include short-term traders, momentum strategies, and leverage positions. This increases liquidity in the short run, but it also increases fragility. When positioning becomes crowded, even a modest shift in expectations can trigger outsized moves in the opposite direction. The second-order effect appears during the pullback. Fast declines are often less about deteriorating fundamentals and more about positioning unwinds. When leverage is reduced, prices can fall faster than they rose, not because long-term value has changed, but because risk is being repriced. This dynamic explains why sharp corrections can occur without any corresponding change in economic data or policy. Who is impacted first? Short-term participants feel the effects immediately. Their time horizon forces rapid decisions, and volatility can quickly turn gains into losses. Long-term holders, particularly those accumulating on a fixed schedule, experience the same price movement very differently. For them, volatility affects timing, not strategy. The broader implication for retirement-focused investors is behavioral rather than mathematical. Volatility tests discipline. It creates the temptation to evaluate long-term decisions based on short-term outcomes. When that happens, portfolios are often adjusted at precisely the wrong moment. Not because the thesis has changed, but because discomfort has increased. Another important cause and effect relationship involves diversification. When equity markets remain elevated while volatility rises in alternative assets, correlations can shift temporarily. This does not invalidate diversification. It highlights that diversification works over cycles, not weeks. Assets designed to protect purchasing power or reduce long-term risk may not move smoothly, but they often respond to pressures that equities ignore until later. Finally, there is the issue of expectations. Periods of low volatility tend to compress risk perception. When volatility returns, it feels larger than it statistically is. The market has not necessarily become more dangerous. It has become more honest about uncertainty. Understanding these dynamics reframes recent price action. This is not about whether an asset is safe or unsafe based on a single pullback. It is about recognizing how markets process risk, how participants respond under stress, and why long-term outcomes are driven more by structure and behavior than by short-term price swings. Periods of sharp price movement followed by abrupt pullbacks are not unusual in financial markets. What matters is not finding a perfect historical match, but understanding how conditions evolve before outcomes and where today's environment clearly differs. Looking back, previous cycles in precious metals and broader markets often shared a common pattern. Long periods of consolidation, followed by breakouts that initially felt unstable. In several past instances, early advances were interrupted by fast corrections as positioning adjusted. These pullbacks occurred before longer-term trends were fully recognized by the majority of investors. Historically, the most volatile moments tended to appear early in a new regime, not at the end. Early participants tested conviction, leverage was reduced, and weaker hands exited. Only after this process did trends become smoother and participation broaden more sustainably. This sequence is visible across multiple asset classes, not just metals. However, it's equally important to identify what is not the same today. In prior decades, financial systems operated with lower overall debt levels, fewer financial derivatives tied to commodity pricing, and a more domestically focused capital flow structure. Today's markets are far more interconnected. Liquidity conditions in one region can affect pricing globally within hours, not weeks. This accelerates both advances and pullbacks. Another key difference is the role of long-term institutional participation. In earlier periods, price discovery in certain assets was driven more heavily by speculative capital. Today, longer horizon participants, such as institutions managing reserves or liability matching portfolios, operate with different constraints and timelines. Their activity tends to be less sensitive to short-term volatility. It is also worth noting that many past comparisons focus on what happened after a peak or a collapse, which can distort perspective. History is most useful when examined before outcomes were obvious, when uncertainty was highest and narratives were conflicting, much like they are now. The lesson from history is not that prices must follow a predetermined path. It is that emotional responses tend to repeat even when underlying conditions change. Volatility often creates the illusion of instability, when in reality it is part of the market's process of adjusting to new information and participation. By grounding today's environment in historical perspective, without forcing conclusions, we reduce the risk of reacting emotionally to normal market behavior. History, used correctly, doesn't predict. It filters noise. Rather than asking what will happen next, a more professional approach is to ask what could happen under different conditions. Markets are probabilistic systems, not linear ones. Thinking in scenarios allows us to manage risk without relying on certainty. Below are 3 clean conditional scenarios, not predictions. Bull case, conditions strengthen. If underlying financial conditions continue to support real assets, then price strength can persist over time. In this scenario, liquidity conditions remain accommodative relative to historical norms, and long-term investors maintain or increase exposure to assets perceived as stores of value. Volatility may remain elevated, but pullbacks are absorbed as demand appears at higher price levels than in prior cycles. For this to occur, price declines would need to remain orderly, meaning sell-offs are driven primarily by short-term positioning rather than forced liquidation. Stability in broader financial markets would also be required, as extreme stress elsewhere tends to overwhelm all asset classes temporarily. Under these conditions, price action would likely show higher lows over time, even if advances are uneven. This would signal acceptance of a higher valuation range rather than speculative excess. Base case, conditions stabilize. The base case assumes neither acceleration nor breakdown. If volatility moderates and markets adjust to recent price ranges, assets may trade sideways for an extended period. In this environment, enthusiasm fades, but so does panic. Participation becomes more selective, and price discovery slows. This scenario often feels frustrating because it lacks momentum in either direction. However, it is common following periods of sharp movement. Time rather than price becomes the main variable. From a risk management perspective, this is often the environment where disciplined accumulation strategies quietly work best. The absence of urgency reduces emotional decision-making, allowing long-term participants to operate without pressure. Importantly, a stabilization phase does not negate longer-term theses. It simply reflects digestion, markets recalibrating expectations after rapid change. Bear case, conditions deteriorate. The bear case requires a clear shift in underlying conditions, not just price weakness. If liquidity tightens materially, leverage is forced out across multiple asset classes, or broader financial stress emerges, then prices could revisit lower ranges. In this case, correlations would likely rise, meaning assets that usually diversify risk could decline together in the short term. What would define this scenario is not volatility alone, but duration. Sustained selling pressure combined with declining participation would indicate a structural shift rather than a temporary adjustment. Even here, it's important to distinguish between price damage and thesis damage. A bear scenario does not automatically invalidate long-term arguments. It changes timelines and entry points. Professional risk management focuses on survivability during these phases, not precision. The purpose of scenario analysis is not to choose the most optimistic outcome. It is to remain prepared across a range of outcomes without emotional overreaction. Markets rarely reward certainty, but they often reward discipline. Rather than focusing on headlines or day-to-day price changes, I pay closer attention to indicators that reflect underlying conditions. These tend to shift before narratives do. One of the first is the US dollar index, DXY. The dollar often acts as a pressure valve in global markets. When the dollar strengthens rapidly, it can create short-term headwinds for internationally traded assets. When it weakens or stabilizes after a strong move, it often signals easing financial conditions rather than immediate price direction. Next are treasury yields, particularly real yields. Changes in yields influence opportunity costs. Rising real yields can pressure non-yielding assets in the short run, while falling or stable real yields often reduce that pressure. I focus less on single data points and more on trends across weeks and months. Inflation data, such as CPI and PCE, also matter, but not in isolation. What's more important is how markets respond to the data. If inflation readings surprise and markets remain stable, it suggests expectations are already well anchored. If similar data suddenly triggers outsized reactions, that tells us something has shifted beneath the surface. I also monitor volume and liquidity. Large price moves on declining volume tend to fade. Moves confirmed by sustained participation are more likely to persist. Liquidity conditions often explain why prices overshoot in both directions. Finally, I watch positioning and open interest. Sharp increases in leverage often precede volatility, not because leverage is bad, but because it reduces tolerance for uncertainty. When positioning resets, markets can stabilize even without positive news. None of these indicators provide answers on their own. They form a mosaic. When several begin to align, they offer insight into risk, not certainty about price. The goal is not to react to every signal, but to understand when conditions are changing versus when markets are simply processing noise. When markets become volatile, it's natural to search for certainty, but certainty is rarely available and it's rarely necessary. What matters more is understanding context, managing risk, and maintaining discipline when conditions change. Short-term price movements can feel significant, but they often reflect positioning and sentiment rather than lasting shifts in structure. Long-term outcomes are shaped less by reacting to every fluctuation and more by staying aligned with a coherent process. That means thinking in probabilities, not predictions. It means respecting risk while remaining patient. And it means accepting that volatility is not a failure of markets. It is how markets adjust. This isn't investment advice. It's simply how I'm reading the market right now. If there's one takeaway, it's this. Being consistently disciplined over time tends to matter far more than being perfectly right in any single moment. Thank you for taking the time to watch.